Okay. Peter Rose, Longwood Currency Trading. Poker and currency trading have a lot in common. And I'm not talking about gambling or anything like that. These are important differences and similarities that you should be aware of, regardless of how much experience in either poker or trading that you may have. I think everybody's had a little bit of experience playing cards, and if you're watching this channel, you've got some experience in trading. So I think it's important that we look at this, because without an understanding of risk, you can't do either one. And sometimes, I think every time, it's easier to understand your risk and your tolerance for risk and managing risk in a card game like poker than it is when you get into trading. I talk to people that just they play poker, but they don't transfer those thought processes of skills and what's reasonable and what's not reasonable into their trading, and I don't think they're experiencing the success that they should. So I hope you watch the entire video, because I think there's a lot of stuff to be gotten out of that. I'm outside today, blinding in the sun. It rained yesterday, but I wanted to bring you out and show you in New England. We're just starting, this is early October, we're just beginning to start to see the colors change in the trees up here. It's well, it's kind of a late fall season. We're still in autumn. You can see the trees back out in here, and they're really not bright. These guys started turning a while ago, and now they're even dropping the leaves. So it's going to be a little while before we get the full color of it. We're very early October, and even down where the brook is here, we're not really seeing all the color that I think that we've got to go. All right, so I thought I would come in. The grass is soaking wet, my shoes are wet, so I'm just going to pause on that. We're actually later going apple picking out to the central part of the state. We're going to take a drive. It's a couple-hour drive out there, and might get a couple of pumpkins, and so it'll be a great day. I'm still in that trade that I've been talking about over the last couple of videos that went severely underwater with me, caught in the volatility of this really historic movements in many of the major currency pairs. I'm in a trade in pound dollar right now, and it's retraced 50% of the loss that I had. So, it's just like that, boom, in one day. So we're moving in the right direction. I'll keep you posted on that. And that is the thing that I guess generated my thoughts on risk and risk management, and to take the slant of looking at a poker game. The problem in trading with so many of us is that we don't like to take a loss. But if you go into a poker game, you're constantly losing. When you throw your hand, you lost. You can't play the game unless you put your ante in. That's a risk, because if you're going to toss your cards, it's automatic that you've lost your ante anyway, and maybe 1 or 2 rounds of betting before you toss in. That's your entry stop. That's all to do with your entry stop. If you play the hand through and you get beat at the end, it means that maybe it held for a while in the direction that it was going in. You thought you had a chance. You stayed to the end and played it out. Price just flushed against you, and boom, you're gone. In a poker game, what do? You throw your ante in. The cards are going to be dealt again. You get another run at it. So what's the problem that we can't translate that kind of risk management into our trading? The dollar value involved is certainly equal or actually far greater than what you would have in a poker game. I mean, when I was playing Texas Hold'em back in the day, I was going to games where you were putting a week's salary up. That's the level of game I was at. And it was a lot of fun. I didn't mind losing several times in a row because I knew I'd make a little bit. Don't win every time. Sometimes you go away and you get taken to the table. Rarely would you go to the wood. It's managing your risk. If you have a certain amount of money that you're going to allocate towards your poker playing, you bring a certain amount of that to the game, which is based on the size of the game that's there. I mean, if everybody comes to the table with a couple of $300, you come to the table with a couple of $300, or $500 or $800 or whatever. You don't want to get out stacked by some other fool. Currency trading is the same thing. You know, you look at your entry opportunity and you say, wow, this particular price action that's going on has the potential to really be a good momentum move, and so I'm gonna enter with more lots than maybe I would if the situation was different. There's a lot of things that are consistent in trading. One of the things that I think should be consistent as you're learning is a static standard short pip stop range. You know, 8-10 pips, and that's it. If it isn't going to work within 10 pips, it may not work within 500 pips. So just get out. But other things are variable, like how big do I want to go in? Do I want to stage? Do I want to and what type of staging do I want to do? A pyramid, upside down pyramid, static staging points, variable staging. How do I want to play this hand that I've been dealt? That hand is what the market is doing right now in the general price action that's going on, and you have to have some vague awareness of the economics in the two different countries. I mean, if you're trading a dollar pair, then you know, if you got an on-farm payroll day coming up, or if you know, some central bank has just declared a 75 basis point up in the interest rates, you probably ought to take aware of that, because that's going to change the field. Just like in a game of Texas Hold'em, when a guy goes all in on you, you know, you got, whoa, wait a minute, this kind of changes the thing here. He's either really got the nuts or he's really trying to bluff me out. I mean, those are positions that you don't want to be in if you're holding weak. And in currency trading, when you're looking at that entry analysis, those decisions that you make at the entry analysis are going to vastly affect, if you get into the position management phase of your trade, are going to vastly affect how you manage that position. If you've gone in with fear on a light load and the thing starts ripping in your direction, what are you going to do? You're going to go in heavy at that point? I don't think you could afford to. And the reason for that is, where is your average price line in relationship to the current price? If it's very close, then just a brief movement against you takes you out. Not makes you wonder about setting your stop better, but it takes you out. Well, if you go in too heavy and you judge the momentum incorrectly, boom, then you take a bigger hit in the beginning. These are all issues that you want to have rules for up front. Now, you don't want to have so many rules in your trading that you go, oh, I'm gonna fudge this one. You don't want to have rules that you fudge. It's either a rule and you do it, or you don't have a rule because the situation doesn't call for one. It's only later in your trading that you can be flexible at changing the rules based on a change in the strategy that happens as you get into the further into the position management of your trade. You may think that you're getting close to your exit point, getting out of the trade, and all of a sudden the landscape changes. You go, whoa, I got to get out either right now, or whoa, I'm going to back up the truck here because this thing is going to take off and I want to be on board. So in some respects, all of the rules that you develop should have risk in mind. Now, that's not to say that you're focused on the risk, because you want to take care of your risk right up front with a short stop, a 10 pip stop, an 8 pip stop, whatever you want to do. And I mean, I sometimes do carry trades, long-term trades, and I'll go into the trade thinking, you know, if this doesn't manifest itself today, I'll carry it over into tomorrow or the next day. My stop is still the same distance. Because either the direction is correct, my analysis is correct, or it's not correct. And if it isn't correct, I don't want to ride with it for 20 pips, 30 pips, 40 pips. How long are you going to let it go? I got a 200 pip profit target. What am I going to do? Put a 100 pip loss point to it? How many times do you think you're going to get a 200 pip profit target? So if you lose 100 pips when you're in this stupid risk-reward balance, which doesn't make any sense at all, but all of you seem to think that that's important, look at the mathematics of it. It doesn't make any sense. And I have a degree in physics and almost a minor in math, so I know what I'm talking about. When you're making these decisions, they have to be based on not how you feel that day, or, you know, it's Tuesday, whatever it is. Because price action is going to be the same no matter what's going on. It's the magnitude of it that's going to vary. The direction is either going to be, it's going to go up and it's going to be in your favor, it's going to go down and it's going to be against you. Well, if it's going to be, and those are complex issues to handle. And fear is the worst one of them, our fear of loss, right? And so, what are you going to do? You're going to have a 20 pip stop, a 30 pip stop? Why don't you take that risk, that entry risk fear out of your trading and put that short stop there? The same way if you were in a poker game, Texas Hold'em. You throw your ante in, the flop drops, and the betting starts, and you look at your cards and you go, how am I going to improve this? You know, a 6-9 offset, and I got a guy to my right that's thrown down $50 bet or $100 bet. What am I going to do? I'm going to keep that. I got a rule. No, throw it away. I got an ace queen. I'll see the next card, even though this guy went for 100. I'll see that next card, because if we drop an ace or a queen, I could be in good shape. So that's a rule that you have to have. When do you fold your hand? You know, the old Kenny Rogers song in the movie, I forget what the name of the movie was, but you got to know when to hold them and you got to know when to fold them. And your entry level is your greatest source of consternation in your trading. Because if you get that wrong, you don't have position management. So wouldn't you better like to know that you got it wrong right away than wait 30 pips and go, oh man, I got this wrong, I'm 30 pips down? Well, how are you going to make that 30 pips up? If your win-to-loss ratio and all that stuff, how do you get a good win-to-loss ratio value if you don't lock down on your risk at the opening? If you don't understand that, if you're afraid to put a stop, then you shouldn't be trading currencies. You put that stop there and you get knocked out. Great, the stop is there with a very little value of money so that you can go back in with confidence when the price actually does turn around and start going in the direction that you thought it would go in. And then it turns around and it comes back against you, get out. Either the price is going to go in your favor or it's not. If it doesn't, how long are you going to wait for it to come around? How long are you going to hold your position hoping that the price is going to reverse and go the way you wanted it to go or the way that you thought that it was going to go? You can't fall in love with this stuff. You can't have an opinion that price should do this. That's the situation I'm in right now, and it's tens and thousands of dollars against me. Because I'm so strongly biased in understanding the economics of what's going on. Oh, I know that eventually the event that I'm expecting will occur. The only question at this point, because I hung around too long, is will I go to the wood before that target is realized? And that's not a position that you want to be in. I don't mind it because I balance out my skills and the size of my bank and the amount of money that I've made so far this year, and I'd still be up a great percentage if I stopped trading right now and lost a large part of my money. I'd be okay. But being okay is not what I'm looking for at 73 years of age and having 40 years of real estate experience and 33 years of career in software engineering, 55 years in martial arts. I'm not afraid. I'm not afraid. Because I know I'm good. I know I can get the job. Or go out, when I was looking for software engineering jobs, in fact, I was turned down, didn't make me go home and throw up in the toilet. That I didn't get the job. I go out and look at another job. I'd send another resume because I know my skills are good. I'm not getting the jobs because I got shitty skills. I'm not getting the job because my skills don't match what they need. Right? And in currency trading, it's the same thing. It's not about my skills. I just made the wrong choice. So if I make the wrong choice, I should get out. But here I am, because of these historic times, of trying to take advantage of this volatility and make as much money as I can, so that when I do take a big hit, because I will take a big hit at some point, I want to have a lot of buffer in order to cover that, so that at the end of the year I'll have a lot of money. I'm not in this thing to make 10 grand a year. I'm not in it to make 40 grand a year. I'm in it to make a lot of money. That's why I'm trading a six-figure account. But I'm rabid about risk management, as you would need to be in your poker playing. If you didn't get the cards, throw them away. Take the hit, because the cards will be thrown again. If you're trading off as a day trader, you trade generally around that 5-minute chart, because you've got 12 decisions to make an hour as to whether you want to go in or you want to get out or you want to add. So having the ability just to get out with a short loss is so important, because many times on that 5-minute chart you'll be in the trade, you'll be loading up heavy, and the price has gone like 6 or 8 pips, and you'll see the price start to stagger and it'll start coming back against you. And what are you going to do? You're going to sit there while it goes through your average position value and you go to negative in your position management stage. Is that what you want to have happen? No. Boom, you got to cut it. Make 2 pips, make 3 pips. Doesn't make any difference. 3 pips is 0.3% per thousand of risk. So if I'm trading a mini lot, which has a margin requirement of $500, I'm going to put $1,000 in there and have $500 of buffer, because it's easy for me to figure out what my gain and all that stuff is. What I'm really saying is that I'm not just risking the $500 margin. I'm willing to risk the $1,000. Now, the broker won't let me go below a certain point of value. If that starts to eradicate itself, if I go below the leverage limit, which is 50 to 1 on the account, then I'm going to get jacked out, right? So that $1,000 is what I'm putting up for risk. If I had $2,000 in my bank, but I'm only trading one mini, I'm not risking $2,000. I'm only risking the 1,000. See, so, and when that's gone, then I'm out of the game, even though I got another $1,000 in the bank as buffer. Because what am I going to do? Carry the thing out? So I'm losing 800 pips, I guess, and a mini. And it is possible to go 800 pips underwater on a trade. The latest thing with the huge deterioration of the pound. As I said, I made a trade in the Baltimore airport, and when I landed, I made $900, taking advantages of volatility. But in 2 days, the pound dollar dropped 900 pips in 2 days. So, what does that do for if you're studying long term on your charts and you're looking at the ATR? What does that do to that? What does it do to all those indicators that are out there? It renders them useless for literally days. So I got an ATR of 15 on my 5-minute chart. Really? I don't think so. You really have to understand your currency pair and trading. You have to understand yourself, because otherwise you'll be fearful of the risk, and you won't have the confidence and the joy in your trading to take advantage of the momentum when it is moving in your favor, to load it up, to put everything you got into it. If it doesn't work out, well, as soon as it starts not to work out, get out and take a loss. Don't sit there while the thing deteriorates to the point where your loss is 5 or 6 times what you could have cut it short from. If you're going to sit down at the currency trading desk, it would be helpful if you'd look at how you used to play poker. Now, maybe you weren't a very good poker player, but it's really easy for you to determine why. It's easy for me to determine why a trader who comes to me and says, oh, I'm not really successful, I'm losing everything. It's relatively easy for me to see why. But it isn't easy for a person to be able to see that themselves in trading. But in poker, you can say, oh man, don't draw to an inside. Don't draw to an inside straight. Don't try for a flush when you need 3 cards. Just stupid stuff. Risk management is at the forefront of your mind. That's the thing that guides whether you're going to be a success or a failure. But if you're trying to do all this risk thought and all of the profit thought, you're not going to do either one of them very good. So take care of the risk up front, make it a short risk, get out. If you're in a position that's running and it starts to stagger and your profit target is 10 pips away, forget about it, get out. Take what the market offers you. When the market starts to say, I'm going to start taking a little bit of this back, and if you're stupid and greedy, I'll get it all. You don't want to hear that. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.